lives in a lovely neighborhood. If you live there, they say you're living good. Pretty lawns with fancy landscapes. She stares ahead with a blank gaze in her lovely neighborhood where the living is good.
And good afternoon. This is Marc Gertz, and you're listening to Reverse Your Thinking on KMET. That was the lovely Angie Wells, who's going to be performing March 2nd at Vibrato in Bel Air. For those of you that are nearby, check it out, vibratogrilljazz.com. It's going to be a hell of a show. She's going to be premiering that new album, and guarantee it'll be a good time. You know, I was reading an article last week, and it got me thinking about some of the things that politicians do and that voters do in cities without thinking about the consequences. You remember a couple of years ago in LA County, they passed a condom law? Yeah, a condom law, all right, that guaranteeing that that porn actors wore condoms. So they passed a law that said if you want to make X-rated movies in the city of Los Angeles, the county of Los Angeles, you had to wear a condom. Sounds like a good idea, right? Except that all that happened was that the porn industry moved to Ventura County, where they are now. Didn't do a thing. Same things happened with homelessness. You know, Los Angeles isn't just one city. You've got a whole bunch of little cities around it. You got Beverly Hills and Culver City and Santa Monica. And Santa Monica started passing laws in regard to homelessness, and the result of that was that the homeless population just moved across the border to Venice, and now Venice all of a sudden had a homeless population because Santa Monica said, "Oh no, you can't sleep on these streets." All right, nobody coordinated, nobody figured out that people could move down the street. Same thing just happened last year with this new mansion tax. Did you hear about the mansion tax? Mansion tax. Can you believe that? Yep. We, the voters, passed the mansion tax, which puts a tax up to 4% on any property between $5 and $10 million, and a 5.5% tax on properties of $10 million and over. That's what we did. That's what we did. We passed a tax that if you wanted to buy a house for $10 million, you're going to have to pay the city $550,000 for the privilege of living in the confines of Los Angeles. You know what the result has been? Property values in Orange County are going up. Just because, I mean, Orange County really needed a boost, right? Yeah, okay, great. They weren't high enough before. Yeah, well, guess what? They got a boost because now people in those brackets are looking for houses just down the road, over the border in Orange County, and that's going to save them $500,000 in property taxes for the purpose of buying a house. I mean, people got to think this stuff out. It just doesn't make any sense that we pass regulations without thinking of the consequences, folks. You know, you got to think these things out when you cast your vote. It sounds good, but you got to dig in a little bit and figure out what the potential consequences are. That's a big problem that people don't think long term enough in terms of what's going to happen. But Orange County is real happy. People living in Orange County, their property values are going up now, and the real estate business in Orange County is seeing an increase in demand from former LA residents or investors looking for higher return on their purchase. I mean, just unbelievable. And then, if that wasn't bad enough, Tesla slashed its prices across the board. Now, I don't have a Tesla, but a lot of my friends have Teslas. And you might be wondering why I don't have one. Well, that's because I don't like Elon Musk's politics. And frankly, I don't feel like putting any money in his pocket. I'll look at other places for my electric cars. But a lot of my friends do. And Teslas have had a certain, panache for a while now. It's like the electric car to buy. But then he slashed his prices by 20%. 20%. People are pissed about this. They really, really are, because all of a sudden they bought a vehicle for full price, and now all of a sudden he's knocked it down by 20%, and the values of their vehicles are going down. In addition to that, they feel like chumps because they paid full price for it, never thinking that he would slash prices. And guess what? In addition to that, because he slashed prices, all, all of the other car makers are starting to follow suit. So they're slashing prices too. Now, on the surface of it, you would say that's pretty good. That's good for consumers, but not necessarily, because if there isn't enough profit margin in these cars, they're not going to promote them. They're going to promote gasoline cars where they can make more money. Anyway, I thought that was absolutely amazing. And sometimes you have to reverse your thinking about the things that you read, because what you read is not really what it is. We'll be back right after this. And we're back on Reverse Your Thinking. I'm your host, Marc Gertz, with engineer Sean, who's making sure that you can hear this out there on KMET. By the way, if any of you out there want to talk about any of these things, we're willing to listen. Just give us a call at 951-922-3532. But don't do it if you're driving, okay? Pull over to the side of the road because you've got absolutely nothing else to do, and call me at 951-922-3532 and tell us what you think. Speaking about what you think, do any of you know who Jack Gutentag is? Of course you don't. All right. I barely know who Jack Gutentag is. No, I really do know who Jack is, because I'm a mortgage broker and I specialize in reverse mortgages. Well, Jack came out with a really interesting opinion the other day that I've never seen before, but I do agree with. And he said that the reverse mortgage has not reached its potential due to the general aversion of advisors with the product. And I quote, "The three existing sources of retirement funds, financial asset liquidation, annuities, and HECM reverse mortgages, are standalone products offered by different industry groups that have nothing to do with each other." Gutentag writes, "As a result, the substantial synergies from combining them are unrealized." Okay. In other words, nobody's working together. He goes on to say that part of the reason for this is a general uninterest that financial advisors have for reverse mortgages. This leads to a lack of consideration for any plan that incorporates reverse mortgages, he writes. And I quote, "HECM reverse mortgage lenders are completely specialized except for a few small commercial banks that offer them. This segmentation prevents retirees from selecting the combination of expected longevity and rate of return on financial assets that maximizes their spendable funds during retirement." This is a big deal. It really is, because my mortgage practice is specifically designed to work with these advisors, and we try to educate, collaborate, and problem solve with them to find solutions in a fiduciary manner for their clients. And if they're already predisposed not to consider reverse mortgages as a potential solution, then guess what? It doesn't get considered. And you lose the value of that, because you don't have an independent person saying, let's look at the entire picture. Let's bring your house back into the picture and see what we can do about solving your retirement income problems. And in addition to that, financial advisors, CFPs, sometimes CPAs, they're in a position with clients to be in a very proactive place, to be in a situation where they can advise them long before reverse mortgages are even in the picture. But if they're brought into the conversation early, when people are in their 40s or 50s, by the time they hit 55, when they can be eligible for some reverse mortgages, and 62, when they can be eligible for all of them, they can internalize how they're going to put these things together. You can have conversations with your kids about what the disposition of your house is going to be after you go. Most people think they're going to leave the house to the kids, but historically speaking, kids don't keep the family home. Matter of fact, 80% of the time nationwide, they sell the family home. Now they might keep investment properties, but they don't keep the family home most of the time. And it doesn't make any sense for people to be in a situation where they're suffering because they're on reduced fixed incomes and they can't make it, and not, potentially tap in to their homes as an asset. Financial advisors are in a unique position to be able to do something about that. But unfortunately, many of their companies advise them not to refer their clients for reverse mortgages. And one of the reasons for that is because they have preconceived notions of what reverse mortgages are. And maybe a lot of you in my audience also have a preconceived notion. And it's time to reverse your thinking. That's why I named my company that. All right. Because you got to get off your soapbox of saying something's bad if you can't explain why. Now, I'm not saying that reverse mortgages are perfect for every situation, but like any other financial tool, they need to be examined. They need to be looked at to figure out what is the best thing to do. If you have people in a position of power, in a position of influence, that aren't taking a neutral position on this and looking at it in addition to all other ways to create income in retirement, you're suffering from that. No one else is hurting from that except you. You need to go to your financial advisors. You need to say to them, let's look at everything. Let's look at the entire picture. Don't just put my house on the side and forget about it. Let's look at the entire picture and figure out the best way, the most economical way, all right, to create enough income so that we can retire with the quality of life that we expected. That makes sense, doesn't it? Those are the type of things that we care about on this show. And when we talk about people retiring and getting bad advice, it's a very, very important consideration, because if you can't trust the people you work with to tell you exactly what to do, then, what's it all about? We can't know everything. That's why we get people who are experts to help us. And those experts need to look at the entire picture and need to examine all of the ways that income can be increased and that the quality of your life can be improved. I don't want you to turn off this dial. We've got a great guest coming after the message. Stay with us right here on KMET, Reversing Your Thinking. And we're back on Reverse Your Thinking. I'm your host, Marc Gertz, and I've got a great guest for you guys this afternoon. But let me give you a little lead in. All right. Any of you that have ever talked with a reverse mortgage loan officer know that when you consider a reverse mortgage, the only way you can do it is to use that loan as a first mortgage, that you have to pay off your first mortgage and any other mortgages you have on the property. And sometimes that's good, but sometimes it's not the best solution. And we haven't had another solution until now. And my guest is going to talk about that, because we have a second mortgage, reverse mortgage product. Stay with me. All right. Our guest today is Adam Potafiy. All right. I'm sorry, Adam. I apologize. You can correct me. Adam's an account exec with Finance of America Reverse, which is one of the top 3-4 companies in the country handling reverse mortgage products. He helps facilitate solutions for Americans 55 and older, not 62, 55, including home equity in their retirement plans. Adam, thanks for joining us today.
You're welcome. And thanks for having me, Mark. I'm very, very excited.
It's great. That's great. I'm really glad you could make the time. So I want to just dig right in. You and I have known each other for a while. And and we understand reverse mortgage products, and we understand how they work when they're in first position on a property. But you and your company have now come out with a reverse mortgage product that can sit in second position on a property.
Right.
So that if I understand this correctly, if we have a borrower that took advantage of the low interest rates and they've got like a 2 or a 3% interest rate on their first mortgage, instead of losing that, we can keep that in place and put a second mortgage behind it with optional payments. Is that about right?
That is exactly correct. And really, I think the best way to begin this conversation is not necessarily even with what and the how, but the why. And Mark, you began answering exactly that. I mean, we come out of the lowest interest rates we've seen in a very long time. So we're talking maybe quarter of the country, probably more, refinance their first lien position forward or conventional mortgages. So what we don't want to do now that we're sort of on the flip side of things where the rates spiked up is to pay off all those mortgages that borrowers so desperately wanted when they refied. So the idea here is, because we have seen such an uptick in HELOCs and any second lien has become a demand in the mortgage industry, we decided to sort of put a spin on what we do, because we are a reverse mortgage company. This is all we do, all we've ever done. So we wanted to see how we can use our expertise and really help, particularly seniors, because that is our client base. That is who we serve. That is who we tailor all our products to. So we wanted to see how we can help some of those seniors who refied, they're sitting on 2, 3, 4% conventional mortgages, and all of a sudden they find themselves needing some cash. So this is where we come in with a second lien, with a second lien position reverse mortgage. And what we know about reverse mortgages is they don't require payments. I mean, you've preached that message 1,000 times, I'm sure. So the same idea goes here. The payments are not required, so you're welcome to make a payment. So that is also important to always kind of consider as you're borrowing, as you're getting into anything that's called a reverse mortgage. And I would always call it borrowing, because that is ultimately what you're doing. It's not too good to be true. It's not the bank just handing you money and not expecting you to, make any payments. So while payments aren't expected, you are welcome to make them, because the interest technically is accruing on the money that was borrowed. So the idea here is we'll allow borrowers who have, in many cases have escrowed their property taxes, homeowner insurance on that first lien. So that, by the way, is how we're able to, with our second, the Home Safe Second, as it's called, to streamline the underwriting process, because we don't have to worry about the borrower necessarily qualifying or being able to make their payments on taxes, property taxes, and homeowners insurance. That piece is already escrowed. So it allows for this product to really take legs.
Okay.
At the time that we felt was perfect for seniors who are sitting in those low rate forward loans and are looking to get some cash, perhaps in this time that we're all wrestling through.
I understand. So let's get into a little bit of the meat and potatoes of this second mortgage product. We understand that the need for it is great, because replacing a first mortgage isn't always the best solution, right? It just isn't always the best solution. Does this work? Are there any differences between the way this reverse mortgage in second position works from the ones in first, the Home Safe in first?
So the answer is no. It works exactly the same way. So that's, and I think the most important thing to highlight about the similarities is that it's still a non-recourse loan to the borrower.
Okay.
To where, if for some reason, who knows what the future holds, if what is owed on the house is greater than what the house is worth, the borrower is never left owing that money, that difference.
Okay. A lot of our listeners and a lot of my clients one of the reasons they came to us is because they couldn't qualify for a HELOC at the bank because they were on reduced fixed incomes, right? How does this second mortgage product solve that problem in terms of qualifying?
Great question. Fantastic question. So as it pertains to really all reverse mortgages, the whole DTI approach doesn't really fly. So the reverse mortgage works more like a VA loan, to where we're introduced residual income calculation, to where all we need to see is that the borrower is left, in California, that is, a single borrower, you have to be left with $589 after I've taken all your gross income and subtracted your monthly expenses. And those monthly expenses simply being property tax, homeowner insurance, the utilities, which is just 13 cents per square foot, and then minimum monthly payments on the credit report. As long as you're at 589 or greater, that is a passing residual income score to where the borrower can easily get into this product.
Okay, so 589, you're talking about residual income at 589.
That is correct. For
Okay.
a single borrower, and for two borrowers, it's $998.
Okay, so what are we talking here about in terms of credit qualifications for this product? How does that work?
So the most important thing about credit is that the minimum score is 680. So essentially, we're looking, this loan isn't designed someone with, banged up credit, someone with late, someone with potentially, foreclosure notices, they're late on their payments. This is not for that customer. It's really for somebody who can show that in the last 24 months, they've made the property tax, they've made their mortgage payment, really, which covered the property tax and homeowner insurance. And that essentially allows this borrower to pass what is called the financial assessment, or the payment history piece of the financial assessment. And then the income piece is that residual income I talked about, where we just take their gross income, subtract property tax, homeowner insurance, utilities, and minimum monthly payments. So that is how we qualify someone. And if you did the math, the DTI calculation is a lot steeper than what is the residual income calculation requirement.
Okay, so in other words, if we have a borrower that because of their reduced fixed income, either can't qualify for a HELOC or can't qualify for a substantial HELOC, maybe the bank won't give them more than $25,000, $35,000. This is a good option.
Right, and the other piece to consider here, even if, let's say, you are dealing with someone who's struggling to meet this residual income I'm talking about, the beauty of the product really is that the money that the borrower is qualifying for, this second lien, all of it can be dissipated for the purpose of residual income. So say it's $200,000, $300,000 the borrower is getting through this second lien reverse.
Yep.
We can dissipate that number in order to pass this financial assessment requirement, this residual income requirement.
Okay, so basically for the benefit of our listeners, what we're saying is that the money that they're going to receive on the second mortgage, on the reverse mortgage, all right, can be divided by a formula in terms of number of years, in terms of longevity, and we can create a monthly income out of that and add that to any monthly income they currently have, let's say Social Security or a teacher's pension or something like that, and use that to get them to qualify in terms of the income. Correct? Am I getting that right?
That is exactly correct. And just to sort of illustrate an example here. So let's say you had a 70-year-old borrower that's a life expectancy of 16 years. So if I go to 16 years times 12 months, that's 16 years times 12 months, that's 196 months. So now I'm talking about a $300,000 drop that the borrower can get divided by 196. That means I can get $1,500 out of this $300,000 in terms of residual income add-in.
Okay, so right, so just so our listeners understand, we're not talking about giving you $1,500 a month. That's not what we're talking about. We're talking about a formula. All right, Adam's talking about a formula that we can use to get you to qualify for this loan. All right, that is not available for many other types of loans that you might consider. All right. But while we're on that subject and differentiating, what type of options does the client have with this in terms of receiving money? As we know, on a HECM product, there's 4 different ways to take the money. You can take cash, you can take a line of credit, you can take payments for a certain amount of time, or we can even set up lifetime payments under the HECM product.
Right.
But this isn't the HECM product, correct? This is FAR's own baby.
Right, right. And particularly because it's a fixed rate, which means it's a closed-ended product, by definition, it has to be a one-time deal. So let's go back to our example of $300,000 that the borrower has qualified for.
Right.
That money, it goes to them in a lump sum. It doesn't go into a credit line and doesn't go into monthly payments. It's a lump sum. And that lump sum, by the way, we could reduce if it's, let's say, too much money,
Right.
They don't need it. They could forfeit some of it, leave it on the table, but that money isn't available later to them. It's a one-time deal, lump sum. And of course, payments, as we discussed, are welcomed.
Yep. Okay. Well, some people think incorrectly that that on reverse mortgages, you're limited. You can only do certain things with the money, or you have to get permission to do certain things with the money. How does this second reverse mortgage work in that regard?
Great question. And really, this is something that I deal with on the daily, to where I clarify the fact that at the end of the day, it is truly the borrower's own money that they're extracting out of their equity. So as long as nothing else is being sold to the borrower as part of that transaction or in conjunction with that transaction, the borrower truly, the client, can do whatever they want with the money. I mean, they could literally walk into casino the next day and blow it, and we wouldn't care.
Oh,
Not
no,
to
no, no,
say
we
it
don't want that.
negatively.
We don't want that. We don't want that. We don't want that.
But I'm just illustrating to where it's truly the borrower that's in control, because it's their equity. They're extracting. We're just assisting
Right.
with it.
Okay. Well, that sounds pretty good. What if they want to make payments on it? Can they make payments on it?
Yes, sir. They can make payments. They can make payments monthly. They can make payments quarterly. They can make payments annually. At the end of the day, the payment that is received will be applied towards the outstanding balance, towards what is owed. It's that simple. And just so I don't forget, because this piece is important. So given where we are with the current interest rates, the rate on this product as it stands today is 8.99. It's just hair below what is our jumbo reverse mortgage interest rate is. And of course, as the market improves, as we're able to give back, we'll be able to move the needle on the rate as well. But we are, as it sits today, at that 8.99. And there's just a flat $1,000 lender fee. So it doesn't go to Mark, it goes to Finance America Reverse. It's just a flat fee regardless of the loan size. And speaking of size, the minimum loan amount is $50,000, 50. And the maximum is $4 million. So as you can see, it's a really wide stretch here that we can cover.
Wow. So at $50,000, that sounds to me like there are a lot of modest homes that might be able to qualify for this. Am I getting that right?
You are definitely getting that right, 100%. And that's the idea here. We want to, even though the Home Safe product, we came out with it back in 2017, I want to say, it came out as primarily a jumbo product. So serving client database that's greater than $1 million. This variation of the Home Safe, which is the Home Safe Second, is really meant to serve all types of clients, both HECM and Home Safe, which is jumbo.
That's pretty remarkable.
Yeah.
And I'm just trying to think you talked about a 680 FICO. Are there any, even if their FICO is 680 or above, if they have a bankruptcy in their past, is that going to impact?
That so the borrower is required to pass what is financial assessment with the standard reverse mortgages. So under those guidelines, someone with a bankruptcy, someone with a foreclosure notice, someone with banged up history or credit in any way, technically would not qualify for the product. Now, we could always check all that before spinning any wheels. For that, we'll just need the credit report and an LOE from the borrower addressing derogatories, and we'll give thumbs up or down.
So basically, nobody should assume they're out of luck until they give me a call. You're listening to Reverse Your Thinking. This is Marc Gertz, and we'll be right back after this. Back on KMET, and you're listening to Reverse Your Mortgage, and I'm your host, Marc Gertz. We're talking with my guest, Adam Potafiy, who is an account executive with Finance of America Reverse, one of the largest reverse mortgage companies in the United States. And he's been talking to us about this amazing new product that they have, which is a second mortgage that is a reverse mortgage, which means that making payments is an option, not a requirement. Adam, there's one thing I wanted to ask you about. You know, a lot of people are of the belief that reverse mortgages require them to sign the title of the house over to the lender, and you know as well as I do that that's not true. I wanted to ask you in regard to this product: is there anything different with that?
It is, yeah, that's another good question, because at the end of the day, it is a very important thing for everyone to understand that a reverse mortgage, whether it's first or second lien position mortgage, all it is a lien against the title. The house is truly yours. We're just a bank who's placing a lien against the house because we lent you some money, period. So it's going to work exactly the same way on the HomeSafe Second as it does on traditional reverse mortgages.
Okay, that's great. Switching gears just a little bit, you know, the only thing about this that I'm sort of concerned about is that if you've got somebody with, for argument's sake, let's say a $2,500 a month mortgage payment, and you put the reverse behind it, they still have a $2,500 mortgage payment. Does Finance of America have some way to sort of deal with that? Is there an alternative to this that doesn't necessarily require the borrower to flip the entire house into a reverse?
Yes, sir. I'm glad you brought that up, because what we do have a product that launched early last year, so early 2022, that's called Equity Avail. And what that product is, in a nutshell, it's a hybrid of a forward and a reverse mortgage. So what it means really is that we cut the borrowers, whatever the current payment is, usually the payment is half, sometimes a third of what it was. And that is a required payment from the borrower for 10 years. And after 10 years of, let's call it, less than interest payment, that payment goes away on its own, and it turns into a reverse mortgage. And the LTV, we're able to lend on that product the highest because the borrower is making payments. So it's not a lot, but they're making payments. So they're slowing down the negative amortization of the loan. So it takes off some of the pressure or risk off the lender. So that's how the LTV is the most aggressive, or the loan to value is the most aggressive for this product. And the market tackles exactly what you described here. But of course, this is a first lien position mortgage, which means if the borrowers are sitting in 2, 3, or whatever percent mortgage, we would be paying it off with an Equity Avail product. And the rate, by the way, the rate's going to be different for the jumbo versus non-jumbo, just using the county limits. And the current rate is 7.6 on the non-jumbo in California, and then 8.6 on the jumbo. And this one comes with a 1% origination fee that's also paid to Far and not Mark.
Okay. I want to just tell our audience that, many of you may think that those rates are high, but historically speaking, interest rates in the United States since World War II have been in the 5-6 range. The fact that they were down to like 2%, 3% for a couple of years, that was an exception, not a norm. So it's really important that you understand that the interest rates that Adam is talking about are really in line with what traditionally people pay. Now, a lot of people are suffering right now because with interest rates higher, because conventional lending's around 6%, give or take, they can't qualify to buy a new house, And Adam, I wanted to ask you, is there any way to use the equity avail program or the second mortgage program in doing a reverse for purchase? Is there any way to make that work?
That is interesting time you bring that up, because the equity avail for purchase is exactly what we're working through as it sits today. So hopefully we'll be out in the next couple months, but the idea is to go live with that product, which essentially allows the borrower to, just like a reverse mortgage, reverse for purchase, essentially allow you to double your purchasing power. So if you were shopping for a $300,000 house, now you can go to a $600,000 house, and the lender brings their portion. And in this case, where you used to not have a payment at all with a traditional reverse mortgage, here you would have that less than interest only payment, as I talked about, for the first 10 years, but it allows you to bring an even lower down payment than on a regular reverse mortgage.
Well, that's great. That's really great. Is there any way to use the second mortgage product in a purchase? If for example, if they can't qualify for a first mortgage for enough, is it, you probably remember before 2010, people used to buy houses with first and seconds at the same time. Is there any way to do that with this product? Is there any application?
That is not currently allowed. However, I mean, I see a lot of merit in it, and I don't know where we are with that topic, but I certainly will bring it up with the team and sort of see how or what we're thinking along these lines, to see if potentially it's something we want to roll out.
Gotcha. Okay. Well, let's modify that, and let's suppose you have somebody that has the cash to put down. They can get a traditional mortgage, but they really don't want to. They want to hold on to that $300,000 or $400,000. Is it possible that they could take that money, buy the house with the 300 or 400, and then take out the second mortgage reverse afterwards to get it back and put it into investments?
Absolutely. So it just would have to be two separate transactions, which means paying two closing costs, which is something we wouldn't want to do for the borrower, but of course they could. But the idea behind essentially looking into potentially opening something like this up is to be able to, do it all at the same time, to where they can only pay one time on the closing costs. But yeah, you're definitely thinking straight in that regard, and that would be really, really interesting if we could swing that sooner than later.
Okay, good. So these are things that are on the drawing board. Okay, great. Well, I really appreciate you coming in. One last question. We don't have a lot of time, but in relation to, you might have heard me talking before you came on about the problem with financial advisors, that Gutentag was talking about having a negative perception of these. Is FAR doing anything with the second reverse mortgage product in that field to sort of turn that around?
As it pertains to like working directly with financial advisors, not on the second.
Not yet.
I mean, this is a relatively new product. I mean, we're literally 2 weeks into it that it rolled out. So there's still a lot of work to be had, but we are absolutely of the mindset that we need financial advisors, planners on board as we're all working together to help seniors unlock their home equity.
Well, that's just great. Okay. You're listening to Reverse Your Thinking. We'll be right back after this. Welcome back to Reverse Your Thinking. I'm your host, Marc Gertz, and we're talking with Adam Potafiy with Finance of America Reverse about new products that they're bringing out in the reverse mortgage market. And before Adam came on, I was talking about the fact that some of the experts in the industry have concerns that financial planners and people in positions of authority are not really embracing reverse mortgages as an option for their clients to create income and retire comfortably. And Adam wanted to stay on because we this is an important part of our business, in the sense that if you have a financial planner advising you, or a CPA, and they're prejudiced against a particular product, they're not going to give you unconditional, unbiased advice. Adam, what's been your experience at FAR with addressing these preconceived notions by authority figures in consumer finance, like financial planners and wealth managers and estate attorneys?
Yeah, what's funny about that is a lot of these preconceived notions, a lot of these beliefs are truly myths. I mean, to the point of maybe even being comical, like to what someone believes about a reverse mortgage. That's just kind of what they heard maybe when 20 years ago or so, and they just never took the time to really understand how the product works, what is it about, and they just believe borderline silly things. So more and more, I would say the last 2 years though, I mean, I've been in the industry for 11 years now. And for the last 2 years, I would say I've seen an uptick in how much financial planners, financial advisors are involved in the very reverse mortgage that some borrowers are getting. And they're recommending them to their clients. And really, about 2 years ago now also, we created an entire division. We have certified financial planner on board that essentially communicates, because we want to be able to speak to that database, help them understand. Because at the end of the day, like you said, Mark, reverse mortgage is not for everybody, but it is for some, and it fits their mold very well, fits their situation very well. So especially when we're talking about the jumbo reverse mortgage, very often we're seeing financial advisors, planners involved, kind of really on the call, in some way, even during counseling. They're really trying to dissect the product. But what's cool is that 2 years down the road now, I'm seeing so many financial planners, so many of them just referring business. Now that they've understood it, now that they, let's call it, drank the Kool-Aid, they can understand how this product can really change somebody's life. And in many cases, we're talking about a credit line. Sure, there's an upfront fee to get it set up, but at the end of the day, having the luxury of having a credit line that has a growth factor attached to it, regardless of what happens to the value of your house, right, it really gives both the borrowers, financial planners, the comfort to, hey, I've got somewhere else to pull money from when my, say, stock portfolio is down, or whatever the reason might be. So I'm seeing so many referrals coming through that channel. It's astonishing, and I love it. And really, we as being the largest wholesale lender in the industry, going on 11 years, we see this as really the way forward for reverse mortgages to really take legs, to really catch wind. We need those individuals to understand the product and be able to recommend them to their client base.
And you know that my practice is designed to work almost exclusively with attorneys and financial planners and so forth. We don't solicit the public directly. We work through their advisors 98% of the time. But one of the things that I've encountered that I want to ask you about is that a lot of people working for large financial planning firms or wealth management firms have told me that their firms have a policy of not referring when it comes to reverse mortgages. And we're talking about big companies managing billions of dollars of wealth. Some of them are Wall Street, some of them are independent. But they what they're up against is they're up against a corporate policy. Is FAR doing anything on the corporate level to sort of change the perception? I mean, I know reverse mortgages got a little bit of a black eye at the turn of the century, because some guys, were sort of like advising people to take reverse mortgages and then putting them in annuities at the same time, and so on and so on and so forth. But it's kind of hard to turn financial planners around if their companies are telling them don't refer. How do we address that?
So as of late, I want to say it's right at December of 2022 is when a new sort of article was published, and I want to share this with you. I will share the entire article with you because I want you to speak on that article the next time you do this show.
Okay.
Because it really kind of addresses exactly what you're talking about. It addresses the sort of the new policies that have already entered that the financial advisor firm legalese that essentially now allows, or in some way requires, financial advisors to understand what this reverse mortgage product is and how it works, so they can be more intelligent about recommending or perhaps not.
Well, I really look forward to seeing that. That would be a really great thing for the public to be able to get unbiased, advice from their advisors. We've been talking to Adam Potafiy of Finance of America Reverse. Adam, thank you so much for coming on. I really look forward to having you back at another time, and I really look forward to seeing this article. And you've been listening to Reverse Your Thinking on KMET. We'll see you next week.
Where the living is good.